How's it going, everybody? Thank you for clicking onto this video. I'm about to play the second part from my 1+ hour conversation that I had with Zoltan Pozsar. In this one, Zoltan gave me his opinion on the state of the commodities market, as well as sort of his outlook on commodities. In the previous one, he gave me his opinion and outlook on the state of geopolitics and the economy, what's really driving the market as a whole. And in the next one, which will probably come online over the next couple of days, he gave me his opinion on how he would go about building a portfolio in an environment that is even more confusing than me than it normally is, and it already normally is very confusing. So any guidance is really helpful. But if you don't feel like waiting for that to come onto YouTube, or you just want to watch the whole thing in one sitting, I will have a link to the full interviews somewhere in the comments or in the description. And feel free to skip this clip and head over there if you want to. And I will just play that clip and shut up.
Commodities, I think, are have their own unique story. The two standard narratives about commodities in a period like this. The Fed is hiking, real interest rates are positive, the economy is going into a recession. The standard narrative about this is, well, look at what happened in the 1980s after Volcker raised rates. And look at what happened after 2008, after the great financial crisis. Commodity prices collapsed. So, if you're going to have a recession, the same is going to happen this time around. There are two reasons why that view is not correct. I'll tell you both. The first one is that both during the 1980s and 2008, you've had a decade of investments in commodities, all sorts of commodities, oil, gas, copper, that you needed for industries to grow. The 1980s collapse in oil prices after Volcker has raised interest rates and the economy has fallen into a recession. The genesis of that was that OPEC had a price shock in the early 70s, and there is a saying, the cure to high prices is high prices. Oil producers in the rest of the world have responded to those high prices by producing more. So the practical implications of the OPEC price shocks were that the UK developed the North Sea oil fields, Norway developed the Norwegian Sea's oil fields. Actually, if you go to the website of the Norges Bank, which is the sovereign wealth fund that manages the oil wealth of Norway, there's a beautiful chart that shows the number of rigs and the number of barrels of oil produced by Norway. And that metric skyrockets in the mid to late 70s, right? Similarly, you had a lot of drilling that happened in Canada and in the oil belt of the United States. So, we had the price shocks, we invested, we pumped, and by the time that recession came, demand for oil fell, and we were basically swimming in oil. The same story in 2008. Everybody knew that when China was welcomed into the world trading system in 2000, they are going to consume a lot of commodities as they beef up their manufacturing base. And so you've had a decade where you've had oil and gas exploration, ore mining, copper, you name it. We all needed that to feed China's voracious appetite. Then came 2008 and a financial crisis, a recession, demand collapsed, but we were swimming in commodities that we have invested in and we were able to produce, but there was suddenly no demand for it. Okay. And so let's look at today. Today is different, first, because we just had a decade of practically no investment in oil and gas. Okay. We've had basically the past 10 years where, the big story in oil was the shale oil revolution in the US. But when you look at the state of shale oil today, it's not an industry that is producing more on the margin, but production from the existing shale fields has peaked. So production is falling, it's not growing. New drilling in shale fields is low because investors have been burned when shale drilling started. A lot of supply came, prices collapsed. And the shale producers are trying to reestablish credibility with investors. So what they are doing is they are protecting their current cash flows, and they are benefiting. They're trying to benefit from high prices for as long as they can, because that's what the investors want. When you look at oil majors, again, they are not investing in oil and gas, but rather they are buying back their capital because it's just an uncertain outlook for the demand for oil, for the policy responses of governments when it comes to fossil fuels. You know, you're going to have to kind of do this big pivot from fossil fuels to clean energy by 2030. So these are all things that are complicating things. And so this price signal that used to exist in the past, where the response to high prices was more production and ultimately the result of that was lower prices, that feedback loop today is broken. And you know, this is not just oil and gas, but this is basically true for copper. This is true for lithium and a number of other things where, you know, to just economically get copper out of the ground is becoming more and more costly and complicated because the kind of easy to get the deposits have been depleted globally. It takes years to get new copper mines online. And commodities are also getting caught up in geopolitics. I mean, you know, just think about the body language we get from OPEC plus. You know, it's less production, not more. Look at the body language we get from a number of countries that produce lithium, for example. There are countries that nationalize lithium resources. There are countries that are proposing to have an OPEC for lithium. There are countries that are saying that we are going to put a tariff on lithium exports if they are exported in pure form, i.e. as powder. But if you turn it into batteries locally, there will not be tariffs on that. So, you know, it's different because typically commodity-rich countries just export their stuff, but they don't renegotiate the way things are done in terms of, you know, basically the themes that I told you is that, you know, some countries that are sitting in a bunch of commodities, they don't just want to be a part of the supply chain, they want to be a part of the value chain. So that's a big deal because the industries that are basically dependent and are consumers of commodities, they want those industries to come to where the commodity is. And so this is one thing that complicates the commodity. I'll come to the second one in a second. So just to summarize, it's a lack of investments. It's the geopolitics that's getting more complicated, and it's the renegotiation of where you are in terms of the supply chain and the value chain. And all of this basically means that commodities are kind of getting encumbered at the source. So that's the first thing. The second thing that's going to make this recession or the risk of recession different from the past is that, and again, this is something that, you know, the markets tend to be blind to in general. You know, a recession is usually defined by two things. You know, consumer spending falls off the cliff, as does business investment in like a cyclical sense. But anywhere you look, you can't escape the theme that governments in the Western world, let's just call it the G7, are pouring trillions of dollars over the next couple of years into three themes. One is rearming, the second is reshoring, and the third is energy transition. Okay, so the practical examples would be building, you know, battery plants and electric vehicles in the US, building chip fabs in the US, subsidizing the energy transition in Europe and the US. Japan building the third largest military by 2025. Germany and France doubling their military budgets. If you listen to earnings calls of the CEOs of defense manufacturers, they are all trying to build extra factories to basically be able to restock faster whatever drawdown we have seen in military inventories since the outbreak of hostilities in the Ukraine. So, and you know, but the price tags on some of these, you know, $400 billion for the Inflation Reduction Act, $50 billion for chip fabs, but that's just the government's contribution. Then there's going to be private capital that's going to match that government contribution. So there's two things here. All this is going to push demand for commodities high, okay? Because I think we are basically at the cusp of an investment renaissance. And, you know, this is going to be one force that's going to push against all these recessionary kind of impulses that higher interest rates are giving us. It's certainly going to slow consumption, but I think this investment offset is going to be quite powerful, perhaps to the point where we won't even have a recession, right? Because again, consumers can slow, but if industry rips, and if some of these things get brought forward, they get doubled inside, they are done with an urgency. And they will have to be done with an urgency because all three of these, whether it's supply chains or rearming and rewiring the grid, there is a sense of national security and supply chain resiliency to it. So we can't really do it by 2030. We needed to do it yesterday, you see? Mm-hmm. So you put these two themes together, you have constrained commodity markets from a supply perspective, a golden age for demand, so to speak. And I would just say that you just look at the laundry list of things that I think we will have to get done. You basically see a commodity super cycle in embryonic form, but it's going to grow. It's going to grow very fast. You wrap it with a more complicated geopolitical environment, and I think you basically set the stage for a big bull run in virtually all commodities, whether it's old industry or green industry or fossil fuels. Constraints are what they are, and geopolitics is what it is. Usually, when you have great power conflict, those periods are very good for commodities, because great powers like to fight over the control of commodities. And again, I think the discourse about commodities has changed tremendously over the past year, because when you think about the fact that reshoring and rearming were not a topic 12 months ago, and when you think about the fact that energy transition a year ago was still conceived as something where energy was cheap, capital was cheap, and world order was unipolar, so it was not going to be an issue to secure the commodities to pull off energy transition. I mean, basically the past 12 months have just added these three items to the demand side of the commodity sector. And so, it's a big topic, but the world has basically changed 12 months ago to the benefit of commodities.
So it's nothing like the 40s. It's nothing like the 70s. It's a complete new type of situation.
Well, it's nothing like the 70s, because the 70s was an oil crisis. Today is an energy crisis. It's a gas crisis. It's an oil crisis. It's an electricity crisis. It's to the point where marquee companies like BASF in Germany is downsizing operations at home and is moving operations to China, for example, as a result. Again, the 70s were the price to capital signal worked. If prices went up, people drilled and we had production. So we knew what the solution was going to be. Today, we are not doing that. We are also keenly aware that the industries to pull off energy transition are still being built. Okay, and the timeline is quite ambitious, and we are in a rush. In the 70s, the kind of Cold War, I would say, was winding down. So by the 80s, we were starting to feel the benefits of the peace dividend. Okay, so the peace dividend is gone today. And so, it's a bit more like the 1940s, where, you have the incumbent and the emerging great powers, and you're basically putting embargoes and restrictions on access to commodities. And so, what one country's commodity problem is another country's technology problem, right? Because the commodity encumbrance we talked about, for example, there is a very strong parallel to that in the technology domain, which is basically the technology blockade that the U.S. has been putting around China quite methodically. And so, everybody is going to basically pour money into industries that are going to give you self-sufficiency in areas where you do not have that self-sufficiency. But that is an investment boom, which is something that I like to remind to people that just see a very long and deep recession coming, because this will be a slowdown that the Fed is trying to engineer that might lead to a housing recession and a housing investment decline. But I think it's going to be offset by this industrial revival in the US and other countries in the West.
How long could that go on for? Like if we call this a commodity super cycle, how long would that be? Is it 10, 20 years longer? I don't know.
Cycles last a long time, a couple of years, 5 years at least, 5 years at least, because again, it's a step change up in demand and a neglected supply side and a geopolitically fraught environment. You have not seen this in 100 years. China coming into the world trading system, I think, was easy because there was the price signal, we responded to it. Geopolitics was okay. And all you need to worry about was figuring out the way to meet demand. And demand is not something that came in a rush. China was a part of the world trading system. We'll build factories. We'll move population from rural to urban areas. We'll do it over time. And they did it over time. Today, we are doing things in a rush. We don't know where the commodities are coming from. And the countries that are controlling the commodities are complicating things.